Mortgage default insurance. Everybody hates them, and most people try to avoid them. That's where today's big question comes in. Should you save 20% in order to avoid the mortgage insurance, or buy a house right away? Let's take a look. Now, before we get started, let's answer a few basic questions like what is mortgage default insurance, and do you need them? Well, simply put, mortgage default insurance is used to insure the mortgage you get in your new house. It typically protects the lenders from you defaulting on your payments, and it's currently provided by three major players: CHMC, Sagan, and Canada Guarantee. And as for why you do need them, it used to be that you needed 20% to buy a house, but the government soon realized that not everyone can do that, so they lowered the minimum requirement to 5% for first-time buyers. But that put the lenders in a tricky situation to take on more risk. Hence, the mandatory default insurance for anyone buying a house with under 20% deposit. Well, at this point, I bet you'll be wondering, how much am I paying for these premiums? Well, let's take a look. Now, looking at this chart, if you make a deposit of 5% towards your house, then you're looking at a premium of 4%, which essentially starts you off with a 1% equity in the house. Now, the premiums will progressively decrease the more you increase the deposit amount. So let's take Ottawa for example, where I live. An average house in Ottawa costs about $650,000. And here's a breakdown of all the premiums you'll be paying based on the different down payments you make. Note that the first tab is 6.2%. That's because you need 5% of the first $500,000 and 10% from $500,000 to $1 million, like I mentioned in my previous video. That brings up the total to $40,000 as a minimum deposit. Now you'll be wondering, this is pretty straightforward. Not only does the 20% down save you from having a mortgage insurance premium of $20,000 to $25,000, but also has the added benefit of having a lower mortgage amount. But that's if you already have the 20% saved up. What if you want to buy a house right away with the 5% you already have, as opposed to waiting to save the 20%? Well, things change drastically in that case. Now, taking the same example of a $650,000 home in Ottawa and fast forwarding 2 years, which you'll take to save up, while also factoring in a 4% growth year on year, which is lower than the 6% in the last 10 years. Now you end up with an amount of $690,000. Not only are you paying $40,000 2 years later for the same house, but you also be paying about $57,000 in rent if you take the average rent in Ottawa times 24 months. And it doesn't stop there. A 20% down payment oftentimes comes with a higher interest rate. Plus, you never know how the market's gonna react in the next 2 years. Because if you've seen my previous video on the 2024 market update, then you should know that we are looking at a wilder market with drastic price fluctuations. So there you go. If you're planning on buying a house with the 5% you already have, then I would say go right ahead and buy it, as saving for the 20% will only cost you in the long term. So make sure to talk to your realtor and your mortgage agent to break it down further and help you along the way. And if you are planning to buy or sell in the Ottawa region, then make sure to reach out in the description down below, and I'll see you in the next one.